So we had lots of bad news hitting the market last week. We had China supposedly banning iPhones for their government employees, and then we had a hotter than expected CPI report that suggests inflation could be flaring up again. Then we had TSMC telling the equipment suppliers to delay delivery because they may have concerns about customer demand for semiconductors. And then finally, we have got the auto workers union strike. All this has caused the markets to chop around in the last couple of days. You can see that towards the end of August and early September, it looks like the market was breaking out. The market was breaking back above its 50-day moving average, and then we got hit by that bad news, and then it went back below the 50 moving average again, and went back above the 50 moving average again, and then finally, on Friday, we had a relatively big sell-off where it's back below the 50-day moving average. So if you actually look at the S&P 500, it is still on an uptrend with the 50 moving average above the 150 moving average. It's still sloping up very nicely. We have got the 200-day moving average sloping up, and the 20 EMA, which is the red dotted line, is still above the 40 EMA. So technically, we're still on a short-term uptrend, medium-term uptrend, long-term uptrend, but the market's been kind of like hovering around this 50-day moving average. And again, it should be breaking out higher, but all this bad news seem to be hitting the market at the same time. So is this bad news creating a great opportunity for value investors to pick up quality companies at a discount? Let's find out in this video. So the first piece of bad news that hit the whole market was that the United Auto Worker members went on strike. And 3 key auto plants and 3 car manufacturers are being affected: GM, Ford, and Stellantis. This is one reason why I don't like to invest in auto manufacturers or even airlines, because once in a while they do get hit by all these union strikes. Now, so far, the strike has only lasted for about less than 2 days, so there's not much damage yet. And the stock prices of the 3 stocks have not really gone down that much, actually, right? But the problem will happen, or the problem could get worse if this persists for some time. Now, this happened in 2019. 2019, the strike lasted for 40 days. GM lost like $4 billion. Ford lost $1 billion. And although the US economy did not go into a recession as a result of the strikes, but the state of Michigan did go into recession because of the strikes. Now, if the strikes persist, it will not just hit the auto companies. It could also hit certain semiconductor companies as well. Now, remember that the new cars nowadays, it takes about 3,000 semiconductor chips to make one car. And there are specific chip manufacturers that may be impacted. One of them is NXP Semiconductors, ticker symbol NXPI. Now, NXPI, about 52% of their revenue comes from the auto industry. So they could get hit pretty hard if this persists. But I'm not too interested in this stock because I don't think that it's got really a strong competitive advantage. What interests me could be Texas Instruments. 25% of Texas Instruments chips is used in the auto industry. So Texas Instruments may get more undervalued. Now, currently you can see, for example, it has been finding support at the 200-day moving average. In fact, it recently sold down back to the 200-day moving average again. Roughly, my intrinsic value of Texas Instruments is about $171. So currently, it is slightly undervalued. So I'm watching Texas Instruments. If it sells down a lot more because of the strikes, this could be an interesting opportunity to pick up some shares of Texas Instruments, because I think it's one of the companies where long run, it will do pretty well. What other chip manufacturers could get affected? Another one could be Qualcomm. Qualcomm recently has in fact doubled down on their investments into the auto industry, as well as Micron. So Micron in fact is the market leader in auto memory chips. But I don't care too much about Qualcomm because I don't think Qualcomm has a very strong economic moat. So it may be a nice trade in the short term, but long run, it's not a stock I want to hold, right? And same thing with Micron Technology. Short term, there could be a nice trade involved, but not too much for long-term investment. Now, is there a beneficiary to these auto strikes? Yes, Tesla may benefit the longer the strikes last. Why? Because Tesla is competing with GM, Ford, and Stellantis, right? But Elon Musk, I have to hand it to him. He was pretty smart in the sense that his workers do not have a union. And the reason was because he told them that, okay, if I give you stock options, then you don't have a union. And they agreed. So although Tesla workers earn less per hour compared to GM and Ford, but they do make up for it because they own stock options. So because of that, Tesla is not affected by these strikes. So while their competitors are getting screwed, Tesla may grab a lot of market share, especially when it comes to the US market. So Tesla may be a beneficiary of the strikes. The longer the strikes continue, the more Tesla may benefit. Now, as you guys know, I don't invest in Tesla in the long run, but I think that it may look like an interesting short-term trade. Now, I never trade on news. I always trade based on technical patterns. If there's a technical setup, I would trade it. And I've made a lot of money trading Tesla using options in the short term. Not investing, but trading. So a big difference, right? And when I look at Tesla, I see what is called a breakout within base setup. So this is when Tesla goes into a base, right? We call this a base. After a strong uptrend, it goes into a base like that, makes a temporary high, and then breaks above that high, and we call this a breakout within base setup. So those of you who have taken my stock trading course or the Wealth Academy Trader Masterclass would recognize this as a breakout within base setup. And you can see that the 20 EMA is above the 40 EMA, so that's a short-term uptrend. The 50 moving average is above the 150 moving average, and the 200 moving average is sloping up. So it is in a very bullish trend, and not surprised if Tesla may hit higher, at least in the short term, both on a technical reason, as well as you have got this auto union strike that's actually maybe helping it gain even more market share, at least in the US markets. The second piece of bad news that hit the markets, especially semiconductor stocks on Friday, was that TSMC, Taiwan semiconductor manufacturing company, told its vendors to delay chip equipment deliveries. So this hit companies like ASML pretty hard, and ASML has sold off pretty significantly. So remember that Taiwan semiconductor manufacturing company is one of the largest foundries that manufactures semiconductors. And to manufacture semiconductors, they need to have all these high-end equipment that's produced by ASML, Applied Materials, Lam Research, and all these other companies. So TSMC, what they said a couple of days ago was that they were having a delay in their new chip factory in Arizona. So remember that their factories are primarily in Taiwan, but now they are building factories in the US. And it's costing $40 billion, and they're saying it's going to be delayed, all right? So because they're going to delay the opening of the plants, so the equipment can't come in that fast. They're also having problems finding skilled workers because they don't want to migrate all their Taiwanese workers to the US to work in the plants. They want to get American workers. But again, it's hard to get these highly skilled workers in semiconductor manufacturing. They are also nervous about customer demand. So again, this hit Applied Materials, Lam Research, and ASML. And I see this as a pretty good opportunity because I love these semiconductor equipment suppliers. Especially my favorite is ASML. Yes, semiconductor demand in the short term can be cyclical, although it's getting less and less cyclical because almost everything that we use requires semiconductors. And again, although there is some cyclicality, you can see in the long run, semiconductor demand will increase. No doubt about that, right? So any kind of short-term slowdown in demand, it's just a short-term issue. And it's a great opportunity to pick up the high-quality semiconductor companies if they're selling at big discounts. So again, like I said, one of my favorites is actually ASML and Lam Research. So ASML is starting to look pretty attractive. One of the reasons why I love this company is because they are a monopoly in the photolithography equipment supplier space. So to make semiconductors, all these foundries like Intel and Samsung and TSMC, they need photolithography machines. And ASML is the market leader, the monopoly in providing these machines. If you do an intrinsic value calculation, at least for me, my valuation of ASML is roughly about $776. So currently selling at $596, it is at a pretty attractive discount to valuation, and it's down about over 30% from its highs. On the weekly candle time frame, you can see that it just closed below this level of support at 604, but there's another level of support at the 200-day moving average on weekly candles at 553. So I'm watching this pretty carefully. In the coming week, if it is able to close kind of like back above this support level, I may start buying at about 604. But if it continues going down, then I'm going to watch this level at 553 and really buy aggressively if it reaches 553. So that's one stock I'm looking at for the coming week. The third piece of bad news is that Apple lost $200 billion in 2 days after reports of an iPhone ban in China, and the market freaked out. So you have to be very careful when you read all this mainstream media news. A lot of it can be very, very misleading. In the first place, understand that China denied this. They say, what ban? We didn't ban any iPhones, right? So the reality is that China didn't ban anything. China discouraged their government employees to own foreign phones. Okay, so it's not just Apple that's targeted, it's foreign phones for security reasons. And it's not a ban, it's an encouragement. Okay, so that's the first thing to understand. Now, because of this news, Apple's down about 5%, right, from the news. Okay, but from the all-time high, Apple's down like 12%. Now, you guys know I love Apple. I used to own a lot of Apple. I sold it at a very nice profit, and I'm waiting to buy it back. Although I do have some Apple shares, but I like to accumulate a lot more Apple if it gets cheap enough. So to me, I love this kind of news. It's a great opportunity to buy more Apple. So first and foremost, is this something to be worried about? Is it a short-term problem that Apple will face, or will it hit Apple's intrinsic value and business model in the long run? Okay. So the first thing is to understand that China accounts for roughly 18.8% of Apple's revenue. So if for some reason China bans everything Apple, which won't happen because Tim Cook and China, they have a pretty good relationship, right? But even then Apple theoretically would lose 18% of its value, but that's not going to happen, right? Okay. Now, again, out of this 18% revenue coming from China, not all of it comes from iPhones. You know, some could be AirPods and MacBooks and tablets and so on and so forth, right? Roughly, you can see over here that iPhone accounts for 52% of their revenue, right? So if you take a look at it, 18%, 52% comes from iPhone. So technically, it's a 9% hit if no Chinese buys iPhones, which is not going to happen, right? Because in China, the iPhone is a status symbol. You know, rich Chinese like to show off that I've got an iPhone, right? So that's not going to happen, right? So what's a realistic hit to Apple if indeed no government employee can own an Apple phone, which is the worst case scenario? Let's take a look at these numbers over here, all right? Now, in 2021, it's estimated that the entire public sector of China employed 400 million people. That's about 33% of the entire workforce in China, which is quite a lot, right? 1/3 of the workforce works for the Chinese government. That's pretty much, okay? Now, so that's 400 people. Now, in China, iPhone only has a 20% market share, not like 50% market share in the US, only 20%. So if you assume that of the 400 million government employees, 20% of them own an iPhone, that will be 80 million iPhones being affected, all right? So is it a big deal that Apple now can't sell 80 million iPhones? Not really, because worldwide, there are 1.5 billion iPhones in use. So what's 80 million out of 1.5 billion? It's about 5%. Okay, so in other words, the worst case scenario, if no government employee in China can buy an iPhone, they'll take a 5% hit. That's it. Okay, that's the worst case, right? So it's like big freaking deal. Okay, so is this a time to buy Apple shares from this opportunity? Let's take a look at the charts. So unfortunately, Apple has dropped, but it has not dropped enough for me to buy more shares as an investment. My intrinsic value calculation of Apple is $167. That's my base case valuation. And my more conservative valuation using a lower growth rate is about $158. So my discipline as an investor is I only buy shares when it's selling below the intrinsic value. Because again, a great business is only a great investment if you can buy for less than what it is worth. But a great business can be a bad investment if you overpay for the shares. So for me, I'll only buy it if Apple goes below $167. Okay. Now 130 is my current average price of Apple shares, which I already own. So I don't mind buying more Apple shares above 130, which is my current average cost, but it must be below the intrinsic value, right? So I've identified basically 4 support levels where Apple hopefully could retrace to before I start to accumulate a position, which is about 162 at the 50 moving average on weekly candles, 149, 134 and 123. These are support levels on the longer term monthly time frame. So in other words, for me, Apple has to get to at least 162 for me to buy just a little bit, but not too much, right? And at 149, when it's below my conservative valuation, I would add more aggressively, and only at 134 to 123, I'm gonna back up the truck. Now, whether it can get there now, I don't know, right? I can't predict where the price will go in the short term, but the discipline is to only buy if I get a good deal. So I keep telling my students, never chase the girl. When the price is flying away, don't chase the price. Always wait for the girl to run to you into your arms, right? Always wait for the price to come to you. If it doesn't come to you, walk away. There are plenty of other high quality companies, plenty of other fish in the sea. So that's Apple, hoping it's going to go lower. Will it go lower? I don't know. I'm watching it very carefully. By the way, if you want to learn how I calculate intrinsic values of every single stock which I'm looking at, as well as how I determine these support levels, do take the Value Momentum Investment course, which you can get and enroll at piranhaprofits.com. Or if you want me to do all the work for you, where I will calculate all the intrinsic value for you, and I will update you on all my buy levels, and I'll give you my live alerts when I buy, when I sell a stock, as well as my option trades, you can enroll into the UIP, the Ultimate Investor's Playbook, where you get to mirror my portfolio every single day. You can find out more at insight.piranhaprofits.com. So the fourth piece of bad news that hit the market was that inflation measured by CPI came in hotter than expected. And of course, that freaked people out because people are now saying, oh my God, then the Fed has to raise interest rates again, and that's not very good for the market, right? So let's see how bad it was. Now, the Federal Reserve, they focus on what is known as core CPI. Core CPI is CPI excluding food and energy. Now, it's not that food and energy is not important. It is important, but the Fed knows they can't control that by raising interest rates. And food and inflation is pretty volatile, and it can go up and down pretty fast. So what they're focused on is core CPI excluding food and inflation. So that number came in at 0.3% month-on-month increase, which is more than the 0.2% expected, so slightly above expectations. And year-on-year, it came in at 4.3%, which was in line with estimation. So the core CPI was not as bad as the headline CPI that was driven up by, again, energy prices and food, which the Fed has no control over. If you take a look at this chart, you can see, right, core CPI, which is this blue dotted line, it is still dropping year on year. Yeah? So it's not as bad as what is reported in the headline news. But month on month, core CPI did come in 0.1% higher than expected. Why did that happen? Where did this increase come from? It came from mainly 2 items. The first was a 2.4% increase in motor vehicle insurance. So this added 0.08% to the core CPI. So why did this happen? Well, simply because vehicle insurance is basically just catching up to the increase in auto prices over the last 2 years. So it's kind of like a catch-up reason that this has happened. And from here, it should kind of like stabilize. The second item is that airfares increased 4.89%, and this added 0.03% to core CPI. Now, what is interesting is that recently, American Airlines, as well as Spirit Airlines, they gave a lower than expected forward guidance. which says that they expect weaker demand for airfares moving forward. So this tells me that this airfare increase month to month may be a one-off item, maybe a one-off gain. It should dissipate from here, right? So these two items together accounted for the additional 0.1% above expectations. So if you take a look at the details, you can see that the flare-up in inflation is not as bad as what is actually reported. Yeah, and that's one reason why I personally think that the Fed is done raising interest rates. I think they've ended their rate hike cycle, but people are still concerned about that, and that is what is holding the market back. If you take a look at the probability of the Fed raising interest rates in the next two meetings, you can see it over here in the Fed Watch tool. So current interest rates of the Fed funds is 5.25%, 5.5%. That's the current Fed funds range. The next meeting is on the 20th of September, which is coming up next week, and you can see there's only a 2% probability that they'll raise rates by another 25 basis points, and a 98% chance they're going to hold rates. So September meeting, pretty sure they're not going to raise interest rates. Now, how about the next meeting, which is November? Now, the November meeting, what's interesting is that the probability of them raising rates has actually gone down, okay, to 27%. So only a 27% chance of them raising rates, and a 72% chance they're going to hold rates at this level as well. So I think we are pretty much done on that. Having said that, the 10-year yield is still rising. So this is the only thing that is concerning me, that with the 10-year yield going up, that could put pressure on stock prices. Although historically, stock prices have been able to increase even with higher 10-year yield rates, as long as people believe the Fed's done raising rates and the economy continues to deliver strong GDP numbers. Now, so where do I see the market by the end of the year? Again, I keep saying that no one can predict the future. No one can predict exactly where the market will go in the short term. All we can do is we can look at the trend. As long as the trend is in place, then the probability is that prices will move with the trend. And as I said earlier on in this video, for now, the S&P 500 is still very much on an uptrend, with the 20 EMA above the 40 EMA, and the 50 moving average above the 150, 200 still sloping up. So the path of least resistance is still on the way up. So I do expect at the end of the year, the market will be higher than where it is today, barring any unforeseen circumstances. Now, finally, let me address the question about whether the stock market is currently overvalued, because there are people on social media or the media saying that the market is now in a bubble, it's going to burst at the top. Is that really true? Well, let's take a look. So the current price to earnings ratio of the S&P 500 based on the last 12 months of earnings is 22.3 times. So is that considered high or low? Well, if you compare it to the 5-year average PE ratio of 22.6 times earnings, it is below the 5-year average. But if you look at the 10-year average, it's 20.9 times earnings, so it's slightly above the 10-year average. So if you take a look at the 5 to 10-year average, you can argue that the current S&P 500 is not that expensive, but it's also not cheap as well. It is more or less at the fair value line. However, if you look at the S&P 500, year-to-date gains, a lot of the gains came from a few companies. We call them the Magnificent Seven. You've got Nvidia that grew 203% this year, Tesla up 148%, Meta 138%, Amazon 62%, Google 52%, Microsoft 43%, Apple 36%. So it is these companies, the Magnificent Seven, that accounted for most of the gains of the S&P 500. So they skewed the PE ratio up to 22 times. Now, if you don't include all these companies, you find that the rest of the companies, the 493 stocks, basically only gain like 4% for the year. If you take a look at the S&P 500 equal weight ETF, which is RSP, ticker symbol, it's up only 4% for the year because the equal weight ETF is not skewed by these Magnificent Seven. And if you just look at the S&P 500 equal weight ETF, the PE ratio is only 16.84 times earnings. So in other words, if you exclude all these guys which deserve their high valuations because of their high growth and predictability, the rest of the market is actually only 16 times earnings, which is somewhere here, which is way below the historical average. So to answer that question, I would say that a lot of stocks are actually very cheap. But again, don't buy stocks just because they're cheap. Only buy the high quality stocks that are cheap, and there are still quite a number of them in the market today. These are the stocks that I invest in every single week. All right, so to find out more, do go on to piranhaprofits.com or check out our UIP subscription at insight.piranhaprofits.com. Hope you enjoyed this video, and may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.